Hello, my name is David Osorio. I'm going to be presenting my chapter 1 to 4 project about Lazy Sofas Furniture Incorporated financial statements. So we have our given problem. We have our beginning balances over here of our all accounts. We have our transactions during 2024 and our data for adjusting entries on December 31st. So we're going to start by recording journal entries for transactions in 2024. So we're going to start with A. We borrowed $27 cash on July 1st, signing a 6-month note payable. Since we know the accounting equation is assets equals liabilities plus stockholders' equity, cash is part of assets, so it's on the left side of the accounting equation. So increasing that account, you can increase that account by debiting the account. So we have over here a debit to cash of $27. And since it was a 6-month note payable, we're gonna credit. And since notes payable, it's a liability, and on the right side of the equation, we increase that account by crediting the account. So we credit notes payable short term since it's less than 1 year. And we debit cash, credit notes payable for $27. And then we go on to letter B, we purchased equipment for $17 cash on July 2nd. And we have right here on our journal entry, since equipment is an asset on the left side of the accounting equation, we debit equipment, increasing that account. And since the cash we're paying out, we're going to credit that account since that credit decreases the cash account. So we're going to debit equipment 17 and credit cash 17. And then we have C, we issued additional shares of common stock on July 3rd for $5 or 5 million, 5,000. We have right here C, since the investors gave us cash with debit cash on the left side of the accounting equation. And since common stock is part of stockholders' equity and it's a naturally credit account, it increases by crediting it. So we increase common stock by crediting it common stock by 5. And then lastly, for this part, D, we purchase additional equipment on August 4th by paying $3 cash. So the same thing as B, we debit equipment and credit cash. And then after that, we can prepare an unadjusted trial balance. So from the beginning balances that were given in the problem, plus the entries that we just made, we can do an adjusted trial balance. For example, we know that at the beginning of the year we had $6 of cash, and then with our um, transactions during 2024, we can know that 6 plus 27 plus 5 plus 62 plus 8 plus 2, and then we also subtract all the cash account minus 3, we do minus 41, minus 11, and that number is 38. And that way we can do it with all the accounts that we have at the beginning, plus the journal entries that we did on the transactions. So we plus or minus everything, and that's going to give us the unadjusted trial balance on all the accounts that we have over here. And then at the end of the year, we have to record adjusting journal entries for things used up or expenses that we need to record. For example, we have amortization for 2024 of $2. So on K, the adjusting journal entries, since we already know that expenses are always debited, and we debit amortization expense of $2 since it's already incurred, and we credit accumulated amortization that's an contra asset account since it increases that increases by crediting it. We have L, supplies for $4. We're counting on December 31st. So if you look back into the ending balance of the supplies, and the ending balance of the supplies of $4, you know that the supplies were 12. So you subtract 12 minus 2, so the expense it's 8. So you debit supplies expense for 8, and then you credit supplies because they were going out. You decrease the amount of supplies by crediting it. We do M, depreciation of $2 for 2024. So we debit the depreciation expenses already incurred for the year for $2, and we credit accumulated depreciation that it's again same as the amortization. It's a contra asset account, and it increases by crediting the account. And it's just as it says, accumulated. It keeps accumulating until it's depleted. Then we go on to the next thing. We have preparing an adjusted trial balance. So for the adjusted trial balance, we take into account the previous unadjusted trial balance that we have here, and then we add the transactions or the adjusting journal entries that we just did before, and we basically do the same thing. We add up all the accounts that are affected by the adjusted trial balance. So for example, we have here on K, amortization expense. We have amortization expense here of 0. We do +2, and then we have amortization expense of 2 at the adjusted trial balance. And we do the same thing for every single entry into every single affected account. Sorry, let's see. Doesn't let me go forward. I'm sorry. Technical difficulties. Okay, and then after we do our adjusted trial balance, we can begin to prepare an income statement. So our income statement is revenues and expenses, revenues minus expenses, and it gives us net income. So we take from our adjusted trial balance, we take our accounts that belong in our income statement, such as we start over here, service revenue, supplies expense, salaries, depreciation, amortization expense, interest expense, income tax expense. So we take them into the income statement. We first put revenues, put our total revenues, our expenses, and then we subtract them, and then we have our net income of 10. And that's our income statement. And then after that, we have our statement of return earnings. So that includes our beginning return earnings balance that we have over here, or $4, plus the net income of this year that we have in our income statement, net income, less dividends. And since we don't have any dividends for this company in this year, we don't subtract anything. So we're left with an ending return earnings balance of $14, 14,000. And then we can move on to preparing our balance sheet. And we also use the adjusted trial balance for the balance sheet. But we use other accounts that are the permanent accounts, such as cash, account receivable, supplies, all the assets, liabilities, and stockholders' equity. So we have our current assets. This is a classified balance sheet. So we have separated current assets to normal assets. So current assets, we can see that cash, you have the same amount, 38, 4 for account receivable, 4 for supplies, and then the same thing with accounts payable. We have five notes payable, short term 27, and you just transpose every single account that belongs on the balance sheet. And you gotta make sure that the total assets and total liabilities and stockholders' equity equal, since the accounting equation is assets equals liabilities and stockholders' equity. And then after that, we have our preparing our closing entries, all the temporary accounts that include basically all the accounts that are included in the income statement, such as service revenue, supplies expense, and all the expenses. So for the closing entries, we do the opposite of uh, of the beginning balances of the accounts. So for service revenue, the normal beginning balance, it's a credit. So we debit service revenue by 71, and we do the same thing for the expenses. And at the end, we also credit return earnings with the difference of those entries, and also that equals our net income that we saw on the income statement of 10. So then after that, we post the journal adjusting and closing entries to the ledger. Um, for example, we have right here our closing entries. If you can see all the starting with with service revenue, we see that we posted the credit balance of the normal balance is the credit balance. It was 0, we added 71, and then the closing entry 1, that's what this means. We closed that account by 71, so it's 0. And the same thing may happen with interest expense, income tax expense. So the beginning balance was 0, we added a 1 in the problem N, and then we close the account by crediting 1 and closing entry 1. And the same thing happened with all the revenues and expenses, the temporary accounts, and everything tied back together uh, to increase return earnings and pass those temporary accounts, close them into the return earnings that it's a permanent account. And then we prepare a post-closing trial balance to make sure all our debits and credits equal. So as we talked about, we go back to see the ledger, and we pretty much look at all the ending balances and post them into the post-trial balance. So the ending balance of cash, as we can see on the back, it's 38, and all the permanent accounts are the same. So the only thing that changes are the zeros that you can see right here on the bottom, and are all um, the zeros that we can see on the all the expense accounts and the revenue. And then after that, we can determine our net income and also analyze our capitalization. So pretty easy to report net income. We already saw it twice on the income statement and on the closing entries. So our net income is 10 because we had total revenue 71 minus expenses of 61. So that gives us 10. And then on the problem, it ask us what is the main source of capital for the business, if it is liabilities or stockholders' equity, and we can determine that in the balance sheet by looking at current total liabilities or total current liabilities and the total stockholders' equity. Whichever is greater is whatever we have most capital from. And yes, thank you very much for listening for in my project presentation, and thank you very much.